the difference I think between a risk parity concept, again, it's about set, forget. You're not managing. I just had to write in my will what I want my money to do when I die. One of the key things was what can I count on for people not to screw up, where I don't need somebody managing it day to day, and I want just to set it and forget it. No, a risk parity concept for a 20-year portfolio, a 100-year portfolio, is good with me. But if you have the opportunity to be more thoughtful about kind of the nuance, if you think about the assumptions that risk parity makes, they're very long-term assumptions. The assumptions that Gary makes is, look, there are periods where we can clearly observe that it's a bad idea to be long these things compared to cash or whatever the case. Is this predictive? Is it finding a strong carry component in all these asset classes predictive that it's going to continue to provide different positive returns in the future? And we find many papers have found that it is. And so it is an active way if you, and it's very diversified because you're using as many assets as you can and you're weighting them in a risk parity component, but the weighting then, you have the ability to short and the weighting is defined by carry and risk rather than expected risk premia and risk and long only, right? So you're removing that short component. You're having a slightly separate assumption. And it turns out that it has this characteristic of doing pretty well most years, like risk parity does. And then when things really go poorly, especially if it's adjusted slowly, a lot of people have this hang up that carry gets crushed in bear markets, right? But because I think a lot of people relate the word carry to the yen US dollar carry, which tends to be true,
Or vol carry.
or vol carry. But when you're doing a diversified risk parity style carry, what it turns out that most of the time it gets out of the way, at the very least doesn't lose too much money. And sometimes it actually makes positive returns during periods of prolonged bear markets, right?
On average, historically, global carry has had positive returns during the worst quarters for equities and during the worst equity sustained bear markets. There's just no there's just no relationship.
Mechanically makes sense, but it's also not as good empirically as trend in kind of protecting those big abrupt gaps that you see in equity markets because trend is
The
just
trend is
focused on one.
structurally designed to be more responsive during those higher volatility tail events.
It's just for me when I look at if you're thinking about adding on different stacks or different alternatives, to me the next best thing is carry because it also empirically has shown very low correlation to trends. So what are you looking for here? You're looking for low correlation. Equity and bonds have low correlation. Equity bonds trend have low correlation. Equity bonds trends and carry have low correlation and cross correlation with each other, which is fantastic and it's really approachable rather than trying to find alpha managers that can't tell you what they're doing because once the secret's out, you can't sustain it, right?